Welcome to Private Lending Insights. I'm your host, Rocky Butani. In this episode, I interviewed Nema Daghbandan, who's the CEO of Lightning Docs and a partner at Fortra Law. Lightning Docs is the largest software platform used by private lenders to generate loan documents, and they have insights into a lot of the transactions that are happening since most of the largest lenders in private lending use their doc system. It's also used by a lot of smaller regional lenders as well, so they definitely have market share on loan document software. In this interview, we talked about interest rate data dating back from September 2024 to 2025, so looking at the trends over the past 12 months for both bridge loans, which is anything short-term, and DSCR 30-year rental loans as well. We talked a little bit about Lightning Docs as a software product for lenders, what it costs, data integrations, things like that. We talked about what's happening at Fortra Law, and a lot of the content in this episode is mainly going to be of interest to lenders. However, as far as the data goes and the market update, I think a lot of real estate investors and brokers will find this to be valuable. I hope you find this episode to be insightful. Here's my interview with Nema Daghbandan. All right, Nema, thanks for joining me for Private Lending Insights. Tell us about what's happening in private lending as far as the numbers and interest rates and loan volume.
Yeah, it's been an interesting year. I think most private lenders will have felt what I would call downward pressures, particularly as it pertains to rates. They'll also, I think, probably feel that it's been a much more competitive year than it's been before. And obviously, there's a lot of uncertainty in the market in general right now, right? I think it's a year in which there's a lot of feelings. That's the best way to describe it.
All right. So as far as the downward pressure in rates, what is driving that? Is that because there's so much capital in the market and there's not enough deal flow?
Yeah. So when I sit across, my perch in the business is really twofold, right? So I've got the Lightning Docs side of the business, right? And on Lightning Docs, even within Lightning Docs, there's really two segments of that. You have both the RTL, and RTL is such a bucket word, right? So, RTL can be fix and flip. It can be ground up construction. It can be just a non-construction bridge. I won't say the H money word because I'll get you and I banned. But the insiders know what I'm talking about here. But yeah, so you've got effectively the short-term rate product, right? And then you've also got the DSCR product. So let's just, we'll focus on the RTL side for now, because that's where most of the pressure is in terms of rates, because DSCR is going to track, it's going to be some, index above your treasury rates. So whatever the treasuries are doing, DSCR is going to do that. That's not, that's what that market does. Versus the RTL side of it has a very, very different framework, because RTL is really interesting because a lot of that paper, as you know, is going and getting purchased and then later being securitized, maybe being purchased by insurance companies, or call it just, it's going to an institutional investment bucket. But a lot of the money also is not, right? And so a lot of mortgage funds and debt funds are just still balance sheeting those loans and holding that paper. A lot of the mortgage brokers, particularly out here in California, they're just brokering those deals directly to high net worth investors. So the actual end place is very different oftentimes. But I think all of those are feeling downward pressure. And the downward pressure is caused because of the institutional investment appetite. So because of the rated securitizations, the unrated securitizations, that is what's driving the cost of capital down, or bringing a competitive pressure to bring it down. And I think you've seen this there with your own customers, which is there's more desire for an appetite to buy deals than there are deals to be sold in the first place.
Sure. Definitely seeing that as well. Let's talk about the numbers. For bridge loans, what's been the average interest rate over the last, or compare, let's say, the same time last year, from September 2024 to September 2025? Give us a breakdown of that nationally, and then maybe a few of the biggest states like California, Texas, Florida, New York.
So when you talk about the national rates, when we're looking at September of 2024, we were at a national RTL average of 11.1%. Fast forward that to September of 2025, that's now at 10.43%. So we had about a 70 basis point drop during that time period. And if you were just to look at this on a chart, that chart just steadily is declining the entire time. So it's not going up, going up and down. It's just really kind of slowly coming down. It's more or less plateaued in Q3. There was very little rate movement in the last 90 days. So that 10.43 number, I think it was the exact same number in both September and August, if my recollection serves me correctly, and slightly elevated, I think about 10.51 in July. So, but very, it's slowing down, but fairly consistent recently on that. If you take a look at that on the state level, particularly, your 5 kind of big states for RTL, California is still the most dominant state in terms of where you'll see activity, and you'll see the most activity occur by leaps and bounds. And in California alone, the rates, I didn't track all the way back to September for these purposes, but you'll kind of find similar arcs. So if you just go back to January of this year, rates started in California at 10.67% this year. They are now down to 10.14% on average. Florida started this year at 10.85%. And then went down to 10.29%. Texas started at 10.99%, and interestingly, went to 10.62%. So very small drop in Texas. New York started above them all at 11.42%, and it is now at 10.85%. So the actual movement in the rates on average throughout this year, about 60 bips or so down. Kind of depends on the environments. Some markets, like Texas, really only went down 30 bips or so. But interestingly is, when I was telling you earlier about how the market rates have kind of done this and just slowly worked their way down throughout the year. When I was looking at Texas specifically, is Texas actually kind of had a bump up in Q3, which bucked the national trend. So there may be something going on in the waters in Texas where rates can come up a little bit.
And approximately how many loans are you using to generate these numbers?
Yeah, absolutely. So in an average month right now, we're just a little bit north of 5,000 loans. So I think last month we were at 5,540 or so. And that's kind of carried through. Earlier in the year, it was lower. You're probably going to find us in the high 3s and 4s, in the January and February, and then kind of escalating its way through. Traditionally, we've been about 50-50 between our bridge loans and our DSCR loans. But in the more recent months, it's actually been more heavily concentrated on the DSCR loan. So just to put all of that together for our purposes today is, let's kind of assume, somewhere around 15,000 loans or so are going to be in that pool.
In terms of Texas, it seems like Texas has always been that market that has, they have a lot of their local Texas lenders. There's a lot of community banks that love private lending, and that's what a lot of the Texas lenders use to fund their loans. And they've traditionally always been 12% or maybe higher, and so maybe that has something to do with the numbers being a bit high in Texas. That's just what the market is.
Could be, yeah. I mean, so the interesting thing is that if you actually look in you and I have discussed this before as well, which is you actually really have to get down to the county level to have an appreciation for what's happening, because there is a lot of, California is a great example of that. You've got counties like Santa Clara, which have huge transaction sizes. You're closer to $1.6 million per loan transaction, right? And then, but you also get these very small, very low interest rates. You'll get, I think the last time I checked in Santa Clara was like 8.99%, right? So even though that state average was at 10.14%, it really depended on whether you're in Orange County, you're in, LA County, and even that, so if you look at California alone, LA County, Orange County, and San Diego County, right? We're all next to each other. You wouldn't think that there would be that much flux, but there in fact is. Between those three counties is you go another 30 miles and you'll see rate movements, 50 bips or so on rate movements just by moving 30, 50 miles.
Yeah, and I think in Northern California, the breakdown is more like I'm in Santa Clara County and San Jose, but I'm assuming that the numbers are going to be similar for the entire San Francisco Bay Area. But then you go out to the Central Valley, that's a whole nother market, and then Sacramento's a whole nother market, and then there's another market which is just everything north of Sacramento and maybe Sonoma, Napa. that's a challenge with California is it's like a country. You've got these 50 plus counties, and you're taking the average of you've got these coastal markets where there's probably more downward pressure on rates, and then you've got the inland areas that tend to be a little higher.
That's right. And I think you'll see that play out in states like Florida as well as a great example, right? I mean, Miami-Dade versus, Jacksonville Metro are going to look very different.
Sure, makes sense. All right, well, the numbers, if you just look at it overall nationally and then state by state, it seems to be the same, where it's just trending downwards.
That's exactly. I think that's the big takeaway is that, you and I were recently at a conference, and I had asked that same question to a room of, it was all California companies at the time, and I said, by a show of hands, how many of you are reducing your rates, right? And the vast majority of the people in the room are raising their hands at that time, right? So that there is definitely a downward rate pressure. It's going to feel different depending on what market is and which market you're in, and also it may depend oftentimes on the product you're offering, right? So, is it a true bridge? Is it more ground? The more bespoke your model is, right? So I think our clients that are doing, for example, large ground up construction loans, there's just a smaller pool of people that are making those sorts of loans, right? Versus your down the fairway, call $300,000 to $750,000 standard fix and flip. Everybody in the room does that, right? And so you're going to absolutely feel more pressure there than you would in some of the more exotic products.
So having this discussion about interest rates, I can see some people maybe tuning out and saying, okay, I don't care, whatever. It's, I know that the rates are coming down. What's the big deal? But how do lenders actually use this data, or if they use Lightning Docs and you provide them with this data, how specifically do they use Lightning Docs to really get a good sense of the rates in their particular market, or to see what their competitors are doing?
Yeah, it's a good question. Actually, funny enough, it's not something that's specific to Lightning. We don't share the information to just Lightning Docs customers. Anybody in the public that is interested in obtaining this information, we actually send out a very, very detailed monthly report. One of the key items in the report that I think would be useful for most people is we actually break down the top 10 MSAs, and we'll provide a chart, and we'll show you over the past 3 months, what is the total number of loans in that county? What is the average interest rate? And what is the average loan amount? And it provides a real-time opportunity to benchmark. The funny thing about the Lightning Docs data specifically is I just enjoy the data, right? It's not designed to do anything other than curiosity. This space is very opaque, and it always has been. And so anything that I think we can do to add value to the space in general, that will always have its downstream consequence to us. So I think, it's kind of a funny thing where it's more of a personal hobby of mine, because I am a loser with no hobbies, than it is something specific to our Lightning Docs customers.
Yeah, I'm sure there's a lot of data nerds out there like you, or number nerds in terms of this stuff. But yeah, I just, the reason I asked that question is I could just see a lot of lenders thinking like, okay, well, let me figure out how to really use this information and apply it to my business.
Yes, because ultimately, and the lenders are feeling this anyways, right? Because ultimately, is all we're doing is probably telling them something they may know to be true, which is they're out in the market and they're quoting, and they're clearly going to get competing terms coming back in, and that's what ultimately makes the market, right? Is how are you vis-a-vis your competitors in any particular market? And so all I'm doing is I'm actually just reporting that right back out to you, and probably demonstrating what you should know to be true if you don't know to be true already.
And I get to see a lot of borrowers having value in this as well, and knowing, just being excited that rates overall are coming down. It's good for brokers to know as well. But if there was a lender or anyone who reached out and said, "Hey, I only do business in this specific market. Can you give me the numbers on that and tell me tell me why I'm losing out to all these deals where maybe other lenders are charging less?" And that may be an obvious reason, because you've got all these national lenders out there that maybe competing in those markets. But is that something that you could break down for people who request that?
Yeah, absolutely. We do it all the time. People will reach out because our newsletter goes out every month, and it goes out to thousands of people. And so we'll oftentimes get inquiries back in, hey, I'd really love to know more about this market or otherwise. And like I said, I just love the numbers behind it. I love the industry. It's a fascinating place. So, it's a personal curiosity of mine.
Yeah, and just to clarify to people who are not familiar with Lightning Docs,
Yeah.
your data is really just aggregating from the transactions that where the lenders are using Lightning Docs for all the loans that they're closing.
Yes, that's exactly right. That on average, you're going to have about 350 different companies use it every month. And the really nice thing about the data set is that it's not concentrated just in large lenders or just in small lenders. It's actually really well diversified amongst that data set. That most of the larger lenders in the country do use it. So over 50% of the top 50 private lenders in the country use it for at least some of their loans. So you are getting really rich data from that side of it, but also, if you take 300 as the number, right, that also is a ton of people who will use it for one loan for the entire year, right? We don't discriminate as a company one way or another in terms of who a user can be. And so you actually are getting really interesting data points because you'll capture the kind of traditional real estate broker who's fractionalizing loans to high net worth investors. You'll get the mortgage fund people who never sell to Wall Street and have no intent on selling it. You're capturing all these different types. And so it does give you, I think, a pretty good view of the market as a whole. And it's probably from my perspective, probably the best data, at least as it pertains to average interest rates, because that data, as you know, is inside a promissory note. So no one has it, right? That there's no aggregation or a way to aggregate that sort of information because it's not sitting in recorded instruments anywhere.
Sure, that makes sense. And let's switch gears to DSCR loans. Tell us about what's happening with the interest rates with those long-term 30-year rental loans in 2025.
So this was interesting, actually. I pulled this up in anticipation you were going to ask me this. And in September of 2024, the average rate was 7.2%. In September of 2025, 7.24%. But if anybody who's been in the industry is making DSCR loans, you are quite well aware that it has not just sat at 7.2% for this whole year. It had a peak of 7.69% going in January of this year. And so it's been moving up and down because it really is kind of pegged towards the treasury rate. So if you watch a lot of treasury rate volatility, these loans are, more often than not, going to be purchased at some premium above treasury. That spread, which is something we also do track a lot here as well, that has tightened, meaning that the spread between whatever the active 10-year treasury is and what these DSCR rates are, that amount has gone down to about 3.12% over the past few months, where it was about 3.5%. So it is showing you that the buyer market is placing a higher value on the product, which is great. So even if interest rates continue to decline, as I think people are expecting them to do so over the long haul, they really could get some attractive numbers there.
All right. And what about the volume of DSCR loans? What are you seeing from January or even September of last year till now?
Yeah, it's the one time in my life where I get to say I told you so. So at AAPL last year, Kevin and I usually, Kevin came my partner over on the Fortra Law side. We do a presentation every year, just kind of tell you like, hey, here's what we think's about to happen looking at the next year ahead, because we're just constantly talking to our customers and just thinking, understanding what they're thinking about and where are they headed. And also kind of, are there any forces that we're seeing in the background? If I could look at the Lightning Docs data and kind of get some understanding of what's going on. And it was just all flashing lights towards the tail end of last year that DSCR was taking off in a real way, and that it was going to have a FOMO moment for those that were not seriously entertaining it. And that is absolutely proven true in the data. So from a volume perspective, if you track the same cohort of users, so anybody who started using Lightning Docs prior to January 1 of 2024, and you follow that exact same cohort and you follow their year over year production numbers, they grew 105% year over year. And comparing that to the bridge side of it, they grew 34% year over year. So it's just a massive difference between the two. And as you kind of know, a lot of people for DSCR purposes, they're not directly originating, right? More often than not, what they're really doing is they're going to wholesale DSCR lenders to go ahead and originate those loans to them. And so they're becoming the beneficiary. So at least some people are taking our advice because we're seeing that in the numbers, meaning they're at least finding those wholesale relationships. But yeah, that world is massively taking off and continues to be really impressive year-over-year numbers. They're heavily overtaking the aggregate volume on Lightning Docs, even though it's a far smaller data set. We're talking about 40 or so companies in an average month are going to be making these DSCR loans. But they're producing, 75% of they're 25% of the user base, but producing, more than 50% of the actual volume right now.
What do you think has led to the huge increase in DSCR loans? I mean, rates haven't really come down. I mean, the interest rate, the Fed just dropped the rate only, a few months ago. So what do you think is the reason for this explosion in DSCR loans?
It's a few things, right? So, what's funny about DSCRs is yes, of course, it's rate sensitive, right? Particularly on the refinance side, either the numbers will pencil or they won't. But DSCR is interesting for a variety of factors. One is people have to buy rental properties, and they're probably not going to want to fork down 100% of the cash price, right? So people need financing no matter what, and people are still interested in buying rental real estate. And so it's, as a product, it's a beautiful product. It's a 30-year, more traditionally fixed interest rate product. So, which is kind of new to the market, right? For the longest time, let's say, for example, if to your credit union or your other typical sources for these types of loans, they more often than not had a 15-year or oftentimes 5-year or 10-year. They were really non-permanent products. So just the 30-year alone is great for certainty purposes. And so there's just a sheer number of transactions that have to occur, right? And then also you have a maturity default cliff that has to occur because all of these 5-year loans and 10-year loans and all these other loans all come due at a certain point, right? But I think that the ultimate thing why we're seeing it a lot more in our industry, because it's been around prior to our industry or outside of our industry, right? The non-QM people, the consumer guys will all tell you that they were the creators, right? And so it existed prior to us and had a bigger take really outside of the private lending industry. But it's actually great for the private lending industry because, well, you're already working with real estate investors, right? Like they bought a bunch of real estate over the last 10 years because it was doing really well, right? So a lot of people who fix, flipped, and sold don't fix, flip, and sell anymore, right? The behavior of the real estate investor has changed a lot. And so I think it's also just such a natural product fit where you just go right back to the same customer and say, look, I can also help you. I will help you with your short-term financing. I will now help you with your long-term financing. And you're not losing your customer anymore. Because that's the other thing that Kevin and I were harping on. We're like, you don't understand, like this is a borrower retention game right now, right? Your best customers are your repeat customers. If you can't solve all their capital needs, other companies can now and will. And so you may lose a customer not because of anything that you did wrong. They had a great experience with you, but they can just kind of go to one source that keeps repeating and solving their capital problems for them.
Yeah, and for the lenders, it's fairly simple. They're not taking on any balance sheet risk because, like you said, most of the origination is done through a wholesale relationship, and the actual lender of these DSCR loans that fund the loans using their balance sheet, and then they either sell them or securitize them. That's a small percentage or a small number of larger lenders out there. And you said you have about 40 of those DSCR lenders using Lightning Docs. Was that right?
Correct.
Okay. And from those 40, do you think that covers most of the private lending DSCR companies? What do you think the market is in terms of?
Yeah, it's actually an interesting point because it's hard to tell because there's no real good data aggregation in terms of how many DSCR transactions are out there and how many DSCR lenders there are. But I would be surprised if we didn't have something along the lines of 80-90% of the DSCR wholesale operations on Lightning Docs at this point.
Interesting. Okay. And like you said, in terms of the increase from last year to this year being about 100% change in volume, you mentioned that it's for the customers that you already had last year. It's not like the numbers have grown because the number of your customers using Lightning Docs has grown, right?
That's exactly right. That's the really, because whenever we're reporting on increase in volumes, we always need to make sure, and we're talking about the same users, right? Because it's use if we're as a company growing, we're going to skew our own data, right? So we intentionally segment out all of our new users and just says, hey, how are the same people performing year over year?
Yeah, exactly. Just wanted to clarify that.
Yeah,
Great.
appreciate it.
All right. So thanks for providing all those numbers. Why don't we switch gears a little bit and just talk about what you're seeing in the market? Because you talk to a lot of lenders out there. Like you said, you've got the big national lenders that you're in touch with. You've got these smaller regional lenders. Just give us your sense of private lending in 2025 so far.
It's a different perspective based on kind of who is the client that we're working with, right? I think the national shops, they're the ones that tend to have the best access to credit right now and have diversified credit options available to them. So they have great lines of credit. They've got, typically multiple institutional outlets that they can work with. Because oftentimes they are a direct securitizer themselves, right? So they have lots of ways to offload their own loans. And so that gives them the ability to be flexible on cost of capital. For them, they tend to have done really well. So, and that's where a lot of the growth in volume is occurring. For your kind of mid-range and smaller groups, there's obviously going to be exceptions. There's companies, when I look at the data, that have done really well for themselves year over year. And there's similar stories in which people are losing fairly significant volumes for their purposes, right? Because if you did 40 loans last year and you're doing 25, that's only 15 loan counts. So in the data, it's not going to look that much. But for that one business, that's a big deal, right? And so what I tend to see from a data perspective, at least, is that there are some pretty significant winners year over year that took a significant portion of the lion's share. I think it was the top 20 or so of the group that was growing year over year took approximately 80% of the volume share of increase. So really dominating and expanding well. But the vast majority year over year kind of stayed flat. So that is a kind of an interesting dynamic where your average lender probably has done about as well as they did last year, and your institutional shops have done really well.
There have been a few securitizations this year, and it's typically your largest lenders that are able to securitize. Do you see that continuing? Do you think there's going to be a lot more securitizations, and this is kind of the norm in private lending?
Yeah, I mean, you've been in the space for a while, Rocky. Like, securitization is a really funny thing because when it's hot, it is by far the cheapest cost of capital. There's no competitor to it, and it's also the most fickle source of capital available. And so, right now it's hot. When will it not be hot? I don't know. There could be something that happens while we are in this conversation that makes it not hot, and everybody goes in a panic tailspin. So I couldn't tell you where it's going, but for now, yes, the rated securitization market is where real business gets done right now.
Yeah, and I'm working on a content piece to explain securitizations to to people who are not familiar with it, and just explain why it's important to even your smaller lenders, or just anyone who's in private lending, and why it matters. But it's been good to see, because in my opinion, it's kind of an indicator of the health of the capital markets and private lending in general. I just saw that Arch West had a securitization done just this month, which I think was their first one. Kiavi's been killing it and doing a ton of them. So there's been a lot of activity on that front. And
that's one thing I will say is I think you will see a lot of smaller organizations in the next 12 months do their own direct securitization. I think that there was a few years ago, securitization generally required the issue, the lender themselves, to generate at least $100 million a month of loans consistently, right? That was your basic barrier to entry. And if you couldn't do that, then you really just wouldn't be able to play in that world. I think that check size is going to get a lot smaller. I suspect you'll find lenders who are originating closer to, call it 250 to 400 million every year, right? So, 20 to 40 million a month. I think you're going to start seeing much more of that activity. And so it will be an interesting year to kind of watch who is going to market directly.
Interesting, but aren't the costs just so high for doing these securitizations that it maybe doesn't make sense when your loan volume is not over $1 billion per year?
Well, it's proven not to be, right? So, I mean, you're correct, which is that it's ultimately a math equation for these lenders, right? Which is, what is my cheapest cost of capital available to me, less whatever the costs of entering the transaction are, right? So, your average transaction cost probably about $2 million or so if you wanted to do a securitization, right? So it's definitely not cheap. But what I'm seeing is that even despite the cost of the securitization, it still proves to effectively create such a low cost of capital, even after expense, right? So obviously it's a math equation which will vary on a lender by lender basis, but I think the math is mathin' for more people than it used to be.
Yeah, and from what I've seen, there's tons of lenders out there that are doing a few hundred million in volume per year and short-term loans. So that's interesting. I didn't think that I didn't think of it that way. I didn't realize that that might be a trend coming, that a lot of lenders that don't have that billion plus per year volume are going to be able to securitize. So
yeah,
that's interesting. Cool. All right. I know you said you share your predictions at APL, but is there anything you want to share with us just for what's going to happen in the future in 2026?
Well, I kind of hinted at one of them. So you got the sneak peek, which is that I think we're going to have smaller balance securitizations occur, and that you'll find more of that approach. And it's DSCR will continue and has continued. I mean, the really interesting thing is if you get right now we're about what my exact number was, 7.24%, right, national average. And if you look at the underlying data on those DSCR loans, they're pretty evenly split, even between about 6 point something and 7 point something as the interest rate that was offered in the underlying loan documents. And so if you can get that rate, right, if we can move down another 100 basis points or not, which is obviously huge if, right, but that would be rocket fuel for refinance activity, because you'll have a lot of 5 point something percent interest rates coming in. And that will create a very, very significant opportunity. And also, if you kind of think about it as well, is you have the non-QM market also participating in the same loans, but the non-QM market also has a conventional kind of, they're generally going to have conventional lending arms to them. So they're going to get distracted by, once the conventional mortgage market goes well again, everybody that's playing around in our space is going to go away, right? Because it's too small of a space that the general refinance and purchase market is where the real money is to be made, right? So I think will leave us over in the business purpose space with continued great opportunity, particularly on DSCR loans. And obviously fix and flip and everything else will be a beneficiary. The more market transactions, everybody wins, but the refinance opportunity in DSCR specifically could get really attractive next year if interest rates do come back in.
Absolutely. And all these DSCR loans typically have a prepayment penalty of maybe 3 years, sometimes 5 years. And maybe it makes more sense, even if you have to pay some sort of prepay, to just refinance to get your monthly payment down. So
that's exactly right. And oftentimes too, it's a cash flow play for them, right? So can you also take some cash out of the property as well? And so there's oftentimes reasons where real estate investors may take on higher rates or otherwise, because liquidity is the ultimate thing that they're seeking in the situation. So that there's many reasons one takes out a loan, not just to buy a property.
Yep. And the last market update or sentiment question that I had for you is around commercial real estate. Do you have commercial real estate bridge lenders using Lightning Docs?
We do, yeah, absolutely. So, for Lightning Docs purposes, the best way to just think about it is it makes any business purpose loan, right? That's the what we do in a nutshell. And so we're collateral agnostic, we're lender agnostic, all of those things. It's really a system that generates any sort of business purpose loan. So within there, yes, you're definitely seeing commercial real estate, you're seeing multifamily, and on that side of it, there's definitely a lot more interest this year, and particularly towards the tail end of this year. And I think a lot of that is because the opportunity in single family seems to be particularly competitive, right? And so any sort of differentiating factor, whether that be predominantly moving to ground up construction rather than smaller construction loans, or moving into multifamily or commercial, really kind of diversifying out of that really core super competitive product is, I think, you'll find where a lot of lenders will head.
All right. What's your general, thoughts on commercial real estate this year and moving into next year?
It's interesting, right? I mean, I talked to an operator last week and we were talking about it, and it's funny because one is the bucket of what is commercial real estate is so broad, right? And so I don't know, is it a shopping center? Is it a single user or single tenant office? Is it is it a Chick-fil-A? Like, what is the commercial real estate, right? And so it's funny because the headline side of it will tell you is, commercial real estate's in for a lot of pain, and I'm sure there's probably lots of commercial real estate that is in a ton of pain, and is in a heavily distressed situation. But there's just too much real estate to broadly paint that brush, right? So for those lenders, where I think private lending particularly exists in this world is in temporary financing, right? So it's on unstabilized assets that typically have a value add opportunity sitting within them, right? So they're repositioning tenants, they're doing something, and they need the bridge to finance into a permanent option. For the longest time, I think that was the greatest problem and fear, which is the exit, that long-term exit seemed to be very unknown and uncertain. And so why would you don't originate a bridge if there's nobody that's going to take you out, right? Because more often than not, the plan was not to, fix, flip, and sell the commercial asset. It's value add whatever that's going to look like to then get it to a stabilized place to then get a permanent financing loan on it. That's the play there, right? So it's much more dependent on the health of the capital market system for permanent financing. And I think that's what's kind of been coming back. We'll go to commercial real estate conferences like Western States CREF, for example, and the mortgage lenders in that room were quite more exuberant this year, as an example, than they were last year. I think that there's a lot more confidence on the mortgage lender side of, hey, do we feel like we find a stabilized asset value and are comfortable, and they're going to obviously be at much lower LTVs, and they're much, their risk tolerance is much less. You're not finding 9,100 loans in commercial real estate, right? But the opportunity, particularly for low leverage loans, I think will be a really good opportunity this year.
All right. And is commercial real estate something that can be tracked within Lightning Docs where you could say that, hey, that loan was a commercial property versus a residential property?
We don't yet. I think it's actually probably something we're going to be doing next year, is really segmenting off of it. Because for loan document purposes, we've always really started from a more commercial-oriented set. If you actually looked at our loan documents, they much more look like what you would see in a traditional commercial real estate transaction rather than a single-family loan transaction. That's just always kind of been our bent, which, if you think about it, makes sense because the single family world has always really been thought of more so as agency, right? Fannie Mae, Freddie Mac. And so you wouldn't want to have that kind of documentation as your baseline. It just doesn't make sense in a business purpose transaction. So we really always started with an ethos of something that looks more commercial. And so because of that, we don't have to ask and segment, is this commercial real estate? It tends to have different features and functionality. So we'll ask questions like, do you want SNDAs or tenant estoppels, or these things that are lead indicators that, yes, in fact, it's commercial real estate that sits behind it, versus asking you a question, Rocky, is this a commercial piece of property or a residential piece of property?
Yeah, makes sense. All right. Well, I can see how some lenders may find value in that data. Like if they're a commercial real estate only lender, they may say, hey, Lightning Docs, tell me what's happening in your customer base in terms of commercial properties, because that's what I compete with. But
that's right. And that's exactly why we would do it. That's right.
Sure. All right. Sounds good. With that, let's take a break and we'll be right back. Support for this show comes from Forcasa, an amazing data platform for private lending and real estate investing. Private lenders, note buyers, capital providers, real estate investors use Forcasa in a variety of different ways. You can see which lenders have funded which loans. You could see which real estate investors have gotten funding or sold a property or purchased a property. You can see loan assignments to know where the loan was sold to after funding. Many people use Forcasa as a prospecting tool. I personally use it to vet lenders and for general market insights. It's become an essential part of our business, and I just wish I had access to it sooner. We publish some of Forcasa's data on privatelenderlink.com. When you do a search for lenders, you could see the top 20 lenders in each market. And we've also added the top real estate investors in each state and for some of the metro areas. Visit forcasa.com to schedule a demo, and please mention that you heard about them from LenderLink and the Private Lending Insights podcast. All right, and we're back with the Nema Daghbandan, Lightning Docs, and Fortra Law. So, Nema, exactly. So, tell us about the relationship between Lightning Docs and Fortra Law.
Yeah, absolutely. So, Lightning Docs really started as a business tool that was used within the law firm operations. So at the time, myself, my partner Melissa Martorella, and my partner Dennis Baranowski were all partners in the same practice group, which is the banking and finance practice at Fortra Law. So we were writing these loan documents for all of our customers, and we really needed to create a system that could write loan documents nationwide on a variety of different property types, and with a variety of customizations at the client level. Right, some lenders want a 5-day grace period. Some want a 15-day grace period. And so you kind of have to say, well, what's the baseline that we all kind of agree we should operate off of? And then what customization should sit on top of that? So it was really a software tool that we built to mitigate our own malpractice risk, and also for us to be able to deliver documents very quickly to our customers, because as you know, speed is everything in our world. And so we had to be able to perform a lot faster than a traditional law firm would need to perform. And so it's just really a business tool initially. And it wasn't until 2018 that we had our first really request, because we weren't intending on ever creating a software product, at least initially. But some of our customers or some of our law firm clients reached out and said, hey, I know you guys are using some kind of software tool. And the biggest friction we were having with them is that they were overloading us from a bandwidth perspective. Our biggest customer at the time had reached out and they sent us 30 loans that needed to close that day. And I'm like, I've got 5 attorneys. Like I can't, we've got lots of things for us to do. And it'd be one thing if you're going to give me 30 loans every single day, but you're not. You're going to give me 30 loans for the last 4 days of the month. And so I can't hire my way through it if I wanted to, because they're going to be sitting idly for most of the month, right? So that really started Lightning Docs back in 2018. We didn't really talk or market it or do anything like that. And we also, we were all very much switch hitters at the time, right? So I was very much within the banking and finance practice, and Lightning Docs would probably be best described as a hobby for us, all the way up until about 2021. By 2021, we had a substantial number of customers, even though we never advertised, never talked about it. We had enough kind of organic feedback on that side of it to then create more of a serious, call it separation and thought process. So now Lightning Docs is very different. It's got its own completely dedicated team. There's 17 of us that just work on Lightning Docs. I'm still a partner over on the Fortra Law side, but oftentimes there to, kind of talk about the things like you and I are doing right now, right? Where's the market headed? Counsel clients when they've got kind of complex patterns, or they want to talk a lot about strategy, I'm oftentimes involved. But I don't spend any kind of data. I'm not writing loan documents, for example, anymore for the law firm. That's all being done by that team.
Okay. And is Lightning Docs a separate entity? Is it a subsidiary? How do you classify it?
Yeah, it's a totally separate entity. You've got Fortra Law, which is obviously a law firm services-based business, and you've got Lightning Docs, which is its entirely separate legal software business, and your typical corporate formalities and all that kind of stuff.
And I saw that you guys changed the domain name to .ai earlier this year. As AI is really prevalent in the software, or is that something that's coming soon?
So it's really funny. If you actually think about it, Lightning Docs, in terms of its core product, uses zero AI, right? So it is purely a rules-driven system that uses automation without artificial intelligence, and intentionally so, because I have to produce the exact same result 100% of the time, and it has to be exactly accurate. And I don't think that anyone would describe ChatGPT as that. And so, but at the same time, AI, there's no such thing as a software company that is not going to use some form of AI in what they're doing. So for purposes of AI, we are working on lots of initiatives on that side of it. I can give you a couple examples of it where it's really prevalent. Is on the first side is you have a lot of unstructured data. That's really the problem that AI is very good at solving for. We integrate, for example, with Liquid Logics and Mortgage Automator and all these different software companies, and they have their own version of structured data, right? So they've created integrations, but ultimately as we've understand their structure, they will convert it over to our structure, and we can work back and forth and send information back and forth through an API, right? So that's someone has written the rule set. But what about if you're just a user who has either their own LOS or their own proprietary system, or doesn't have any sort of, they're using Excel, but they're consistently using Excel where it's always kind of the same fields, right? That's a really good application for AI going, hey, can AI make educated guesses that this field you have in column C1, that's actually where you put all your loan amounts every single time. And that's what this thing means in our system. And so can we kind of try to shortcut and make effectively everybody integrated regardless of the software they're using? So that's one application that we're working on heavily in the background. And another is basically deploying tools like that directly on the user's machines so that they can actually almost build their own API integration with us. And so that's where we're heavily looking at and using AI. And then the last side of it is our data analysis side is heavily AI based, right? Our developers on that side probably spend more time, in AI than they do on any other application at this point.
Sure. And do most of your customers use LOS to then use Lightning Docs, or do you have more people using Lightning Docs directly?
It's a mixed bag, right? So your largest users absolutely have some form of integration. They have to, right? I mean, nobody's going to want to. It's not even so much that the application takes that long. The application is actually very straightforward. It's probably 5 to 10 minutes for an experienced user to complete the interview. But the greatest fear and threat is, did they put in the wrong information, right? And so that really helps on the integration side of it. So most of the large customers do, but most of the large customers have built proprietary systems. They're not relying on any of kind of the off-the-shelf systems for their purposes. So that's what I see on the large end. And then you've got a ton of users that use a variety. So right now we're already integrated with 6 different LOS. We've got 2 more that are going to be coming on board shortly. So we're by far the most integrated software right within the private lending space. And that's something that we're very disciplined with, right? We want to make sure that, in my mind, even though I love our UI and I spent a lot of time making it pretty, the best software is the one you never knew you interacted with in the first place, right? That's kind of my ethos when thinking about our software, is let it actually be kind of in the background doing its thing without you needing to interact with it.
Great point. And which LOS software companies do you integrate with?
Yeah, so Mortgage Office, Liquid Logics, LendingWise, Mortgage Automator, Baseline, and Lender are our current integrations, and we've got a couple more that you'll see through press releases coming out in the next couple of months here.
Okay, so the idea is that a lender already has the data entered into their LOS, and all they have to do is click a button, say, "Hey, generate the loan docs," and then it does its thing, and it's automatic, right?
That's exactly right? So most integrations will basically feed over all the information known from the LOS, and that it pre-populates into ours. So it really helps streamline the process. It brings the deliverable time down to a couple minutes from 10 to 15 to call it a couple 2 to 3. So it's definitely a nice accelerant in terms of the process. And most importantly, I think particularly for our users' perspective is it's the accuracy of the content, because if you trust your own data, which they do, then they're not worried that the interest rate comes in incorrect or any of the field data comes in incorrect. So that tends to be the bigger value add.
And does your doc set cover everything that most lenders would need, or do you get cases where, hey, I need something customized, or you guys are missing this, or you're missing that? How does that work?
So it's not inherently missing anything, right? So it's designed to be enforceable documents in all 50 states out of the box. You should never need to customize our documents. But that said, a lot of users, and this goes back to kind of what you and I talked about in terms of the use case in the first place, which was we needed to build a standardized set of documents that would work in all 50 states, but then we also had to make sure that it would work to be customized to our clients' needs. And so certain clients, for example, want their own ACH form, they want their own servicing form. So if any sort of, sometimes they want sentence structure changes in our documents. So we're very much in the customization business for our customers.
And what about for larger commercial real estate transactions? Is Lightning Docs a good fit for some of those loans that are, let's say, between $5 million and $30 million?
It's really interesting, and people find it funny that I'll say this, but I always tell people like you should use a lawyer, right? Like in general, like even for a small balance loan, even though like it's not in my interest as a software company to say that, right? And the reason why is it's multifaceted, right? So one is it's great, particularly good law firms will understand they're going to be doing a lot more than just drafting loan documents, right? They're going to be looking for kind of red flags throughout the transaction. They oftentimes act as a dual underwriter. There's a passing of potential risk over to that law firm as well, right? Most law firms have to carry malpractice insurance for this exact reason. If they, on the Fortra Law side, if they have a typo in the loan documents, right, that's their typo, not your typo anymore, that there's some value in that, right? And so I always tell people that it's better to use a law firm no matter transaction size, assuming that the borrower can withstand the cost of doing so, and that your operations can withstand the outsourcing that part of the business to a third party, right? It's always better in my mind to have the law firm do it. And very much that dynamic, I think, gets compounded when you get to larger loan transactions, right? You say, well, those are really, really important reasons at $15-20 million, and it may become less risk at lower dollar balances, right? But that's my philosophy remains the same for both. Oftentimes, the need to drive to something from a law firm relationship over to Lightning Docs, oftentimes it's more of a control related issues. When you're closing 50, 100 loans a month, it's really hard to rely on any third party vendor. It's just the nature of this business. And so oftentimes they need to insource all parts of their business to control that customer experience, because you can have your people work late at night, when it's end of month, and they can work over the weekends, and they have lots more control over the process, rather than everything being outsourced to a third party, and now you're just subject to their turnaround timelines.
Yeah, and the reason I ask about commercial real estate is, I see a bunch of these commercial real estate bridge lenders that charge, they charge a borrower something like $20,000 for legal, but I guess legal covers more than docs. It covers all the other things that you mentioned, and them being sort of like a secondary underwriter, if you will. So the cost of making the docs in those cases is probably not a huge amount, right? Because everything's sort of standardized, it seems like, right, in terms of what clauses you have in your docs, and you're only going to get variation when there's complexities with the assets and the entities, right?
Kind of, actually. So it's really interesting. I think this is one of our key differentiating factors, is that if you think about why was Lightning Docs built? It was not built to be a software product to be licensed out to private lenders. It was designed to help Fortra Law prepare loan documents for its clients. And so, you have a different expectation, right? If you look at your kind of typical software offerings, they're designed as software offerings. They're not designed as legal products and legal offerings. And so we've always had that. We don't water down. So as an example, as if you went to Fortra Law or many other, we've got actually multiple law firms that now use Lightning Docs as well. The product itself is actually quite specific. And so we describe it as features, right? So a feature could be, there's a construction holdback, but within a feature, such as a construction holdback, there's multiple other features, which is, tell me about what's happening with that construction holdback. Do I have a third-party draw management company? Do I have specific inspection fees? Do I have mile markers that need to be achieved by a certain time period? All the others are kind of sub-features within a product feature, but all of that is written into the loan documents. So we don't write loan documents, write very specific loan documents to a very specific fact pattern. So even though you could have the same borrower, same state, et cetera, the actual loan docs can vary a lot between these two, because it's very specifically tailored to a transaction. So that could be number of borrowers, that could be who's signing, all these sorts of things can make changes all throughout the documents. It's actually quite complex. I get hit with questions all the time of like, oh, why don't the LOSs just do this? And I was like, they would if they could. It's incredibly complex. Conditional based language that, and I always joke about, when I know, that there's companies that don't use a system like Lightning Docs that effectively had to build their own version of it, right? Which is try to build this all in. And I always tell them, like, you are in the doc management business. You probably shouldn't be in the doc management business, because I can only do this at scale. It only makes sense if you have a lot of customers. If it was for a single customer, it would never pencil to do what we're doing.
And you also have updates to laws in various states that you guys have to update your doc set based on all of those regulatory updates, right?
100%. And that was kind of the nice thing about for on the Lightning Doc side was because I'm still very much, a partner with Fortra Law, you know, I put my own, livelihood on the line every single time as well, because we still have the law firm writing out these documents every single day. And that's unlimited liability that every single time it goes out, right? So we always had to have a practice of maintaining our documents, right? Through outside counsel networks, through updates, through associations, and through all, there's 10 different sources of how you kind of manage these sorts of things. But we already had that obligation by the fact that we were a law firm drafting loan documents. And so it was nice is the byproduct of the system like Lightning Docs. We already had the institutional knowledge and the ability to maintain all that kind of stuff. But to your point, yeah, it's not a one, when people still reach out with frequency and says, oh, can I just buy your templates? And I'm like, cool, template of what? What is the template? Like, tell me about the transaction. And there's going to be no derivative change between other transactions, because ultimately these aren't templates, right? They're actually quite specific to the transaction you had in mind. And that can change, and it's little changes. And I just give you an example to kind of maybe illustrate the point. If you're in a state like Arizona, right? I should give you a better one. You're in California, right? But let's say that the property's in California and you are, in fact, the borrower is a resident of the state of Arizona. There's a rule in Arizona that says that the community, if you wanted to bind the community property for purposes of that personal guarantee, you need your spouse to consent, not sign, but consent to the guarantee, right? Even though the property is in California. And so there's no way I can guarantee you with 100% certainty that that people who are programming their templates in California ever picked up on that rule, right? Because they're just like, well, you don't need to do that in California. If you want to bind the community property, you, Rocky, just sign. You don't need the consent of the spouse. It's just the California laws are written differently, where they say is one spouse signing is good enough, it's going to bind the community property. So those are the sorts of intricate rules. And so you've got like competing facts or complementing facts that occur, and those facts have so much sensitive legal value tied to them. That's what makes it powerful.
And what would you say to a lender that says, hey, okay, fine, there's that one little case, fine, even if I lent to a borrower who's from Arizona and my docs didn't cover that, so what? What's the consequence of that?
Now you need to try to sue for a breach of guarantee. Well, guess what? You can't go after where are all the assets held? They're community assets, right? When people get married in a community property state, like I'm married, Nema, not worth that much. Me and my wife worth more, right? And so you actually lose the recourse right to go against the community assets. You could only go against the individual spouse's assets. It's a huge ramification for just a minor little detail such as that. I can give you other examples, like you're in a state like Pennsylvania or Ohio where they have confessions of judgment. It's an extraordinary remedy because you could basically go into court upon an event of default and get a judgment against the borrower on day one. Like that's what the recourse would have been if you did it correctly. And if you didn't do it correctly, you don't, right? So just imagine not having that. Like if you went to a law firm and they didn't do that for you, you would sue them for malpractice, right? So now it's just kind of think of that same mentality, which is if you would have sued a lawyer for malpractice because you didn't have this thing, well, don't you want it? Right. And so that's the way that we think about it is very much as attorneys first rather than as software people first.
Sure. And with that, I mean, maybe some people are trying to get their own doc set or ask you for a template because they want to save on costs. But in most cases, the lenders are passing on the costs to the borrower. But regardless of if that's the case or not, what is typically the cost when people use Lightning Docs?
Yeah, it's one of the best kept secrets. So the actual cost for Lightning Docs, it'll range, but our kind of standard retail pricing is as low as $200 per set of transaction docs, or as much as $500, just kind of depending on the number of transactions that a user generates every single month is kind of how that models out. But if you actually look at the document fees in the transaction, which I do, the average document transaction fee that's listed in the settlement statement is $1,344. So they're actually using this as a profit center, not a cost, which I actually admire. You know what? Game respect game.
Interesting, because I'm assuming that before Lightning Docs, if you had to, as a law firm, generated a set of docs, you're probably charging more than $1,000, and in some cases a lot higher because you're doing it manually and you have actual attorneys touching them. So
That's right, and that's, I mean, and it was designed as such, right? I mean, with the we didn't go into this space or this industry not understanding who the clients were and what their pain points were. So, it was always done in collaboration with our clients, and really making sure that the one thing that I think I really am proud of is, and it's just the only way I know how to practice is we're, as a law firm, you're only as good as your services, right? Like, you have to really care about who your clients are. You have to make sure you're performing for them, that they're really happy, right? And so when I went into the software space, I didn't have a software background, right? Software is very, very different. If you kind of think of traditional software companies, they're really growth oriented. They're trying to get new customers, new revenue. That's their primary motivation. And I've always thought of Lightning Docs as really a service company more than a software company in our relationships with our customers. Like, we're really eager to please. We want to make sure they have great experience and are very thoughtful of providing that same experience they would have had at the law firm, even though they're just using us for a software product now.
sure, makes sense. All right, that's great. Now let's talk a little bit about Fortra Law. The Fortra Law is a new brand that's been in existence for now just a few months. I believe it was July 2025. How has that been received by by your customers? Is it kind of seamless now, or are people still getting used to the new brand?
Yeah, I mean, the good thing about Fortra Law, so I mean, just kind of very practically, we were, for those that don't know, we were Drossi LLP for many years, right? Anthony Drossi left the organization, so obviously wouldn't make sense to call ourselves Drossi LLP anymore. So it was just we did a DBA filing and named the firm Fortra Law. So, but for practical purposes, that means nothing, right? So we have all the same partners, all the same attorneys, all the same staff members. The team didn't change at all, right? So everybody who was working with Drossi LLP prior, they're just working with Fortra Law after, right? So it really didn't skip a beat. We had our Innovate conference shortly thereafter. I think that was a really great experience. So, I think from a client-facing perspective, they wouldn't have noticed, right? And truly nothing changed on that side of it, other than they're making their checks out to a different name than they traditionally would have. And so then from a marketplace perspective, it took me years to start calling Kiavi, right? So, over time, that too, this too shall pass for those purposes. But we're really excited about it. We actually love the branding and the name. I mean, it's one of those, whenever we go places, people are very complimentary of us about it. They're constantly telling us, like, I love the name. I have a hard time typing it on a keyboard sometimes, and so sometimes I'll get stuck on the email domains. But it's just got a strong name to it, and I think what I really like about it the most is that it's really easy to tie a unique brand identity to it, right? Fortra is a novel name. You're not interacting with other Fortras in life, right? And so I really like that, because I think it can give you an opportunity to build very, very strong brand dominance around it.
Agreed. And most law firms, the company name is the partner's name, or one partner or multiple partners. And that's just an older way, to do it. But when you get to a large firm, I think from just a branding marketing perspective, it just makes more sense to have a, more abstract name.
Yeah. I made partner in 2015. So it's been 10 years now. Wow. Gosh, I'm old. But one of the first questions I got asked was, "Oh, do you want your name on the door?" And I was like, "Absolutely not. Like, people can't see your last name. They're gonna throw mine on there. Like, what are you talking about?" And you look around my law firm, right? Like the next up, and that was clearly gonna be up in line, were like, Martorella and Baranowski, and these, like, we would be the United Nations names. Like, absolutely not would we ever do something like that. So, anybody that knows me is I would have never wanted. I don't need the ego. I don't care enough. I want to do good work for people. And so I really, and I also think, just practically speaking, is that there's a ton of people. The reason why core organizations are successful is they've got good people, right? And so tying that to an individual's identity never makes sense to me, right? And so I really prefer, because I think people can get behind the concept of, like, we're working on behalf of building an awesome Lightning Docs. We're here to build an awesome Fortra Law. And that's an identity. I mean, that's why, if you walk around our offices, you'll see most people wearing swag. It's just something that I think that it's something greater than them. and greater than any individual person. And I love that.
And tell us about the conferences. You typically have 2 conferences per year. What's the scope? What's the skinny on that for 2026?
Yes, so we're still going to have 2 conferences next year, but we've been really working hard at that, right? I mean, it's funny, a really well-known person in the industry once told me, "You're only as good as your last conference," and those are really accurate words. And so, and in our space, there's lots of conferences, and there's lots of, and even players like, for example, your IMNs and others who are really trying to get an effort to build their own versions of private lending conferences. So there's so many options that didn't really exist prior. And so what's really important to be thoughtful about, what is a great client experience? What is it, if you're showing up to our event, are you getting value, right? Like, we obsess over that. I don't know that people can actually appreciate how much energy and effort we think about that in advance. So I'll just give you an example that probably kind of differentiates us from most other conferences. It's in content control. So when you think about content, more often than not, the way the conferences are monetized is that you sell sponsorships, and the sponsorship package will dictate how many speaking spots you get, right? And that could work, because you could have those people could also be really great speakers, etc. But sometimes that creates weird panel topics, because you're trying to throw disparate people onto a panel that have no real relationship to each other, and you're just like, oh crud, I have to literally get all these people on stage to fulfill my mandate, right? And for our purposes, the reason why we do conferences at Fortra is not because that they're good money-making opportunities. And in fact, that they're a terrible business idea, at least the way we run ours. But an opportunity to really showcase the brand and showcase an ability and a knowledge base within the community, right? So for us, we obsess over, well, what is the content? What are the questions you're getting the most when you're talking to your clients? What are they concerned about? What do they care about? What do they want to know about? And then you also say, okay, well, great. Who is the person that can speak best on this subject matter, right? Who has the most authority? So more often than not, funny enough, is we actually do not have our clients on stage, and we do not have people that we even are trying to work with. We just go, look, I will just recognize that you are a subject matter expert, and you are the person that's going to drive the most value to the attendees because of it, right? That's the ultimate end goal. And if our attendees get value, well, guess what? They'll probably attribute some of that value right back to us, right? So that's our our end game for those purposes. But just give you the most salient example of that. We had kind of a couple conferences ago. We've talked right now. You and I are talking about securitizations, which is great. There's a time and place for securitization conversations, but as we just kind of talked about, that's really out of reach for most private lenders, right? Even if the dollar balance goes smaller, it's still out of reach for most lenders. It's just not something they should know about it. They should understand it, but it's not the thing that's driving them the most. And so in our last conference, we didn't talk about securitization once, right? And it was an intentional choice, right? But what did we talk about? Well, we talked about fraud, right? Because as you know, that's a really big issue right now, right? And there's lots of recent events that caused that issue. So that was one of the reasons why we intentionally had a fraud panel. And the people that we thought were like, hey, great, who are the risk mitigators within these organizations, right? We had like Merced over at CV3 and these people who are just deep subject matter experts of how do I mitigate risk in my organization for these purposes. That was the intent behind the panel, right? We brought in a keynote speaker this time on the AI side of it. And it wasn't your typical, I brought it up first and I was like, hey, this is AI speaker. And Kevin's like groaning. He's like, no, I don't want to have every conference has this AI person. I'm like, Kevin, I agree with you. I was like, but the reason why I want Ross Hartman is I listened to Ross Hartman in my Vistage group, and I listened to him, and I started using AI afterwards. And I go, he was the first person that taught me how I could use it. And I go, and if he could help me understand how to use it, I think the attendees will understand how to use it. And I was loving it because I was sitting through his keynote and I'm just watching people click, 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 click. And it just shows because he was doing his magic. And it was amazing because that guy knew nothing about private lending. I mean, truly nothing. And he came up there and was telling people about how they can use AI agency in their own organizations, giving them playbooks, giving them prompts. And I was like, this is incredible. Right. So that's the sort of stuff that we're going to triple down on going forward, is just making sure that we're providing an incredible conference attendee experience, because we really feel like we got to make sure that they walk away going, wow, this was worth me taking time away from my family, time away from my job, like, because it's huge, flying across the country, was it worth it, right? That's the question they will have to ask when they leave. And it's something we obsess about on our end of it.
Sure. And what about the venues for next year? Has that been finalized?
It's a tough one. So I will tell you, there is good spirited debate going on in our organization. We're for sure going to, we'll continue to have our Newport show. Anybody who's been to Veya, particularly, my gosh, like I live 25 minutes away from Veya, and I still don't ever get over it. Like that view, that venue, it's just gorgeous. So we will do another Newport show. It will most likely be in Veya, but I don't think we've signed any agreements on that side of it. We're still tightening up our other show. Traditionally, we've done it in Vegas. We may or may not do it this year. So, we're still finalizing the plans for there, but we won't be doing, I will give you one clue, and only one clue now, is we're not going to be doing it at the Encore this year. We are going to be switching venues from our traditional venues. So you'll find out soon where that's going to be.
Okay, great. Looking forward to that. Nema, that's all I had on my list for today. Anything I missed? Any final thoughts you wanted to share?
You didn't ask me about what we're excited about, Rocky.
Which is?
It's actually a couple of things that we're actually super excited about on our side of it. So there's two things. So I can indulge you about things we're pumped about. So on Lightning Docs, I'll talk about that side of it, which is, the mortgage world and the mortgage documentation world is moving dramatically and shifting, and it's shifting from a digitization perspective, right? You and I talked earlier about AI application within it. That's one of the components of it. But like we're moving into an e-record world and an e-vault world and just an electronic digitized mortgage. I think there's going to be a lot of discussion of that next year. So that's what we are absolutely focusing on the Lightning Docs side of it. On the Fortra Law side, we're really excited for what I don't think most people appreciate on that side of it is if you looked at the top 30 private lenders in the country, 90% of them are actually law firm clients. I don't think most people are aware of that fact, that the largest institutions have really trusted us. And I think it's because we're multifaceted, right? So it's not saying that they're all using us to close loans or whatever, but they're using our law firm in some capacity. So that could be obtaining licenses. That could be, we're oftentimes the research engine to help them understand compliance. But most importantly of that analysis is that we have very, very good relationship with their general counsel's office. And so I think we're kind of their lawyer's lawyer, right? That's probably the best way we think about ourselves and how we serve, is we want to be able to really serve those general counsels really well. But they are also in a silo. And so I think what you'll be seeing from us pretty early next year is really bringing together the community of lawyers in our industry to really be able to start coming together with some best practices and just bringing that group, because they really haven't been able to. If you and I go to conferences all the time, right? Who do you see? You see the CEOs, right? But you rarely see the lawyers there. And I think we're missing something by not having the lawyers come to these things, because they really, they're way more collaborative with one another, and they're facing the same problems. And we want to be the conduit for that relationship, because I think they know and trust us. And then now we want to bring them together into community. So that is something that I think you'll see announced from us pretty soon.
Interesting. Well, love it. All right. Well, looking forward to your conferences next year, and looking forward to more updates from Lightning Docs and Fortra Law. So, Nema, thanks for your time today.
Of course. Thank you, Rocky. Appreciate you.
Of course. You too. See you soon. And that's a wrap for this episode of Private Lending Insights. Lightning Docs is listed on the service provider directory of privatelenderlink.com. I'll put a link to their profile in the description. Also visit their website, lightningdocs.ai. If you're interested in knowing the average interest rate for various states for the previous quarter, do a search on privatelenderlink.com, scroll past the list of lenders, and you'll find a text block that has Lightning Docs interest rate data for the previous quarter. That's available in almost all states. Do a search for private money, hard money, residential bridge. Or if you want to know the average interest rate for DSCR loans for the previous quarter, just select residential long-term rental as the loan type. We update that interest rate data every quarter, so use that as a resource and reach out to Lightning Docs directly if you have a need for more data than what you find on our site. That's it for now. Thanks for tuning in and listening all the way to the end.